Let's take a look at this week's webinar calendar. If you're a fixed income investor or you've been thinking about how maybe a safer investment could actually be a better idea, then join us on this premiere where we're going to talk about why fixed income investing is timeless. The premiere happens at 10 a.m. on Saturday and it's something new that we're trying. If you've been staying up at night because of market volatility or checking your portfolio multiple times a day and are on edge, then we've got the perfect webinar for you with Yuvraj talking about how you can take advantage of market volatility and what you should be expecting out of your advisor in a year like 2025. If you're a global Indian and are looking at investment opportunities across the world, then definitely China has been on your radar. And if you want to know what the real investment opportunity is in China, then join Harshal on Sunday at 10 a.m. IST where he's going to be talking about the China opportunity. So these are the webinars that we have in store for you. There's definitely something that you could learn about financial markets this weekend. Which webinar are you going to join? Click on the link in the description below to register yourself.
In this video, I am going to talk about risk taking in a mutual fund portfolio. How do you take risk in a mutual fund portfolio? How do you increase the risk you are taking in a mutual fund portfolio? Usually, you take it either through thematics or through buying mid cap or small cap companies, companies with high growth, or by going in for a contrarian investment approach, something which no one else is willing to take, which will reward you for the risks that you are taking against what the market is thinking. So there are some simple approaches through which you can do risk taking. You can also use international funds for risk taking. For example, buying a China fund or a Hang Seng is a good way of increasing the risk taking in your portfolio. Nasdaq was another one. Buying a FANG ETF is another way. So there are multiple ways to take incremental risk in your portfolio, to raise the risk in your portfolio. But how do you do this? How much incremental risk can you take? Can you assemble a portfolio of only the kind of products that I told you? Is it sensible? Does it make sense even if you have high risk capacity? Let's ask Subra what he would do if he wants to take high risk, or whether he would actually want to take high risk at the portfolio level. We'll start with the second question first. For yourself or for a client?
Actually, if I can get a trading portfolio or a momentum portfolio, I think that is less risky than trying to do it on your own, because the fund manager has some rules and regulations, etc. Whereas when you make your own rules and regulations, you may flaunt it, you may break it. So it is worthwhile taking the risk. The question obviously will be how much. Whether you will put 5% of your portfolio or 25% of your portfolio because you like the fund manager's style. So yeah, it could be small cap, or you could, in fact, when I look at small cap portfolios across 2-3 fund houses, you realize that small cap is not really comparable to another small cap.
One small
cap fund may not be comparable to another, whereas large caps are by and large comparable. Right, almost all of them look similar. It's like an index fund. Obviously, all index funds look similar. Similarly, most large cap funds look similar to the extent of 70%. So, holding 2 large cap funds may not make sense, but holding 2 small cap funds may make sense because the fund manager's style could be very different. So, yes, it is possible to increase risk by doing that, by investing in momentum stocks. Fund manager is saying, okay, I will take extra risk and give you an extra return. Right, I'll generate some alpha out of that. So yeah, some of these things are worth doing, but I haven't tried momentum investing much. But yeah, I have invested in small cap. I've invested in, mid cap has always been there. So yeah, I do, and if say small cap doesn't do well for a long time, say maybe 3 years, I'll happily go and put a lump sum there, knowing that in a year or two it will turn around and give me good return. So these are the ways how I increase the risk in my portfolio.
But to what extent? I see people who buy only small cap funds, portfolio full of small and mid cap funds. Would you do that?
No, that would be height of foolishness. That would be height of,
I'll tell you. You're using very strong. You're saying height of foolishness. Why?
No, simply because, see, a portfolio you're creating is not to get a kick. I'm not creating a portfolio to impress you or to impress the world or putting it out saying this is my portfolio. I am creating a portfolio to meet my goals, right? So if I realize that my goals can be met by 7% or 8% return, I can even be in debt funds largely.
Subra, it can't be now, Subra. 7-8% won't meet people's goals.
No. I'm saying then it's like, in a match, you need 20 runs and you've got 9 overs to go. Anybody can achieve it.
If I tell somebody that you'll make 12%, it doesn't excite them.
This
These
is
are
very
the
funny.
people, yeah, it
This is
doesn't.
very funny because if you go and say 12% in US, they'll get worried saying, my God, this guy
What
is
are you doing?
oversaying.
Yeah.
You're oversaying.
No, the point is, in India,
Yeah.
expectation setting at the investor level is not really nuanced. It's not correct actually. It's wrong. So the persons who do expectation setting for the investor is forced to set higher expectations. This is my reading. When the investor sets it for himself and then goes and invests on his own, he is even higher than this person.
Correct.
His expectation is highest.
Correct.
Now with this kind of high expectation setting, where do they go? They go to the place where the risk is the highest and the return looks optically highest in near term.
Correct.
Is that it?
Correct.
Two things.
Correct.
For example, why did people go and buy defense funds at the peak?
Yeah. 1 year return was 706%. So,
Why did people jump only into a momentum investment strategy at the peak?
yeah, same. It looks like, oh my God, if not 106 next year, at least he'll give me 53%.
And the beauty
That kind of a
is,
thing.
when you are running on such high momentum in your portfolio, your 1 year, 3 year, 5 year, everything will look rosy.
Correct.
So you will think this can do no wrong.
Correct.
And that's when everything that has to go wrong happens. Everything starts going wrong. So this expectation setting is not realistic. So when it is not realistic, people think that they should have the whole portfolio only of these kind of aggressive bets. Only then they will not only meet the expectation, to SEBI, they can do better.
Exceed expectation. Retail individual investors are not investing to beat the benchmark. They are investing to meet their goals, right? So, if suppose I see a Sanjeev Kapoor cooking and he cuts a cucumber in 22 seconds, that's great. That's for him. He has to show off to the world that he can do that. I am cooking for 3 people in my house, so instead of 30 seconds, if I take 3 minutes, it doesn't really matter, right? So if I can meet my goals with my portfolio and my advisor, I am doing a good job for myself. How does it matter what the others are doing? So what return expectation you should see? One more problem with return expectation is, let's say from 2019 or 2018, you have been saying you will get 12% return. But it happens that 1 year he's got 24, 1 year he's got 30, 1 year he's got 36, right? When he sees these things, he says, this guy is old. He doesn't understand. Things have changed now. Market now does not give 3%, 4% return. Market now gives 20% return. So he is getting carried away typically by recency bias. You cannot stop it, and the person who is advising him is also getting carried away. He says, yeah, I agree with you.
It's easy to make him agree and invest.
That's it.
So this is the interesting thing on mid-cap. Last year was the 3rd year of super performance. First 2 itself was exceptional. Last year was the 3rd year of high performance. So I was telling people that this is not sustainable. Even what happened last year, I did not anticipate. I thought market would be saner. Market obviously was in a more happy mood and more than willing to pay higher valuation. So at the end of the 3rd year, I saw a lot of people saying, look at the 3-year performance, I am going to invest only here. And they went and made lump sums last year. SIPs were all running there. And now all the SIPs done last year are negative. And they're probably going down further.
Correct.
Right? So after a few good years, you start believing this is for real.
Correct.
And you know why last year's returns happened this way? Because people are doing SIP and lump sum only in that place.
Correct.
And the fund manager is forced to buy the same stocks again and again and again, the same 150 stocks in mid-cap.
Correct.
He has to keep on buying.
Correct.
So the investor is not allowing it to fall and calling it performance. Whereas it is not performance.
No, the investor again doesn't realize that when he sells, the reverse will happen.
It has started now.
Correct. So when he was buying, he took the price up. When he sells, it will go down. In fact, when he sells, it will be more difficult because there will be some only seller and things like that where he won't even be able to exit so easily.
So there's a root cause why he has bought last year like this without applying his mind. is because he saw benchmark outperformance that was too rosy, eye-popping and too tempting. He just could not resist that temptation. That is the truth.
The skill of investing with the help of an advisor or on your own is to have enough control over your own emotions, right?
Discipline.
So you have to have the discipline saying, see, returns in equity either come upfront or come at the end. It never comes year on year. It does not every year you will get so much return, right? That is very difficult.
After 3 years, the fourth has to be bad.
The fourth has to be bad. But the worst case is, you tell him after 3 years, fourth will be bad. Fourth also turns out to be good, and the fifth turns out to be bad.
And fifth takes away everything.
Everything which you got in the last 2 years. So
I was giving this analogy that you had 100 at the beginning of 2024. At the end, it became 125. You made 25%. This year, you are going to lose 40%. I assume. If you lose 40%, technically, your 125 goes to 75.
Correct.
If you lose 60%, becomes 50.
Correct.
Now, this is happening in certain thematics, not in mid-cap.
Correct.
But it can happen in other thematics.
Correct.
In PSU, the same people who refuse to buy at the bottom,
correct,
refuse to avoid buying at the top. So they wanted to buy, they stubborn in buying at the top. So if wherever people are chasing benchmark performance in this way, and wherever they see the best benchmark outperformance and running to buy, this reverse cycle is playing out. You've seen 25% and bought, right? From 125 you're going to 75. For the last 25%.
correct,
In defense it has happened.
correct,
PSU it is happening.
correct.
It is going to happen in more parts. I don't want to predict where, but it's going to happen in more parts, that's for sure.
So equity returns are never straight, right? You know, in India, if you take PPF, it is 7.1%. It will fluctuate very little, maybe 7.5, 7.4 and 6.65 kind of thing. Because it includes government control and it includes a little element of subsidy. So PPF is tax-free, 7.1 is a great return. They put a cap of 1.5 lakhs. So, but 7.1% means when you draw a line, it will be like this. But equity returns are always wavy. So sometimes in a 10-year period, you get all the return in the first 2-3 years and nothing for the next 7 years. So knowing which 3 will happen and which 7 will happen, you have no clue. So sometimes it is completely upfronted and sometimes it is completely back-ended. So if you are happy with the returns that you have got, you get out. But at least manage your expectation, because your expectation of 10-12% is also high in a country where if inflation is controlled, if the RBI and government is able to control inflation to 3%, you will get only about 4% in a bond fund, maybe about 3.5-4% in a bank deposit, and about 6% or 6.5% in equity. That is what you will get. You cannot say last year I got 25, this year how much will I get? You will not get. If you got 25 and what you deserve is 6, deserve in the sense mathematically deserve is 6, you have to have a minus 19. Only then will you come to 6. So that is what is bound to happen. So not understanding that, and second, not understanding arithmetic mean. Arithmetic mean is very cruel, because 1 year of 73% return, all your past sins of 4, 3, 8 is all wiped out. Because you are taking the CAGR. That CAGR tells you 14% over the last 5 years, which looks very good. But that 14% has come because of 1 year of 73. So you have to have yearly returns and CAGR to see how the fund is performing. And you also look at the portfolio and you say, I think something is enough. 73% is enough. Now it has to only go down. Will it go down immediately or will it go down after 1 year? Again, you are guessing. So if you are happy with the return that you have got, at least remove money partially and invest it somewhere else. Invest it in a fund which is not doing well. In fact, I believe if you have 5 or 6 investment, if your portfolio is say 10 items, including some REITs, international REITs. Today that is also available. With all that and everything is in the green, you are not well diversified.
You need something in the red.
You need something in the red, because if everything is in the green, what stops that everything will be in the red? That can also theoretically happen. So you need to understand asset allocation. You need to understand how much you need to do. You need to understand how quickly you will withdraw. You need to understand whether you have some short-term goals. Based on all this, you make your investment, and if some fund is performing very well, but it is very small portion of your portfolio, just let it be. But if it is a significant portion of your portfolio, you will have to come out of those funds and get into funds which are not performing so well.
So you're saying that rotation is required?
Rotation is required maybe 60%.
If you are in these kind of funds.
If you are in these kind of funds.
So whenever you are looking to make higher returns, you will have to rotate.
You will have to rotate.
You can't say I am going to do this fund for a higher return, so I am selecting this small cap fund and I will not sell it for 20 years.
And I'll do a 20-year SIP, I will not sell.
You can't say that.
You can't say that. You can't say, oh, it has got 73% return, but so what? SIP will succeed. SIP won't succeed there. SIP will succeed there because you bought at lower levels also. But this is a fantastic time for you to take some money out and maybe go on a vacation, buy some fancy stuff you want, or invest somewhere else. But yeah, there have been to be times when you get such exceptional returns, you have to remove money also.
Telling somebody to remove money from small cap fund today is actually sweet news to the small cap fund manager.
Yeah.
He may actually like it.
Correct.
Contrary to what
Correct.
everyone thinks.
Correct.
Because he is being forced to invest at a higher valuation because you are continuously giving him money.
Correct.
If somebody takes out, at least he will take the new investor's money and give the old investor. You won't go on further.
True.
Keep buying stocks at valuation he doesn't really like or is not convinced about. It was a very, very interesting conversation, Subra, on both benchmark and thematic. This whole series on mutual fund investing has brought out different dimensions which investors need to appreciate at this point in time, because we are uniquely positioned at a point in time where many products have delivered significantly superior returns to what was expected of them. When products deliver significantly superior returns over what is expected of them, it means they have already captured a good part of the future in the present.
True.
And when they have done that, it is important for the investor to bring his future into the present and make his decisions in the present so that he doesn't regret in the future. Thank you for this exceptional series of conversations on mutual funds. We should have many more on many more subjects in Talking Straight with Subramanyam. Thank you.
Thank you.